From the morning reading, a fractional wait-and-see gain. The U.S. equity trade appears to be in a wait-and-see mode, still conjugating over the weak May jobs report and Fed Chair Yellen's relatively upbeat view of the U.S. economy. The Dow gained a fractional 0.10%, while the Nasdaq slipped a fractional 0.14%. The preferred benchmark S&P 500 rose at the open and moved in a modest rally mode to its nearly 0.5% intraday high in the early afternoon. The index then gave back most of the gains to close at a fractional 0.13% advance. Today's lethargy notwithstanding, the 500 is now only 0.88% from its record close in May of last year. The Spider's new high close forms a potential shooting star following Monday's high breakout. 5 of 9 sectors moved higher on Tuesday. XLE, XLI, and XLK were the strongest sectors, while XLV was the weakest sector. Oil futures rose 72 cents to close at $50.43. This is oil's first close above 50 since July 21st, 2015. The Spider, which broke out of horizontal resistance on Monday, rose on Tuesday, gave back some of its early gains, and formed a potential shooting star. A shooting star is a one-day candle pattern that indicates a potential short-term buying exhaustion and the potential for a short-term pullback. Some short-term traders move their stops below the shooting star to protect short-term profits. This has been a relatively meek rally. During the 80 days since stocks bottomed in February, the S&P 500 has enjoyed only 11 days with gains of more than 1%. That's among the fewest for all 80-day rallies off a one-year low since 1928, but the index future performance didn't seem to be hampered by such a rally with muted daily returns. According to a CNN model, greed has been a sustained condition. The CNN fear and greed model has increased to its highest level in more than 2 years, and it hasn't declined much over the past 3 months. Its 3-month average is now above 80 for only the 6th time since 1998, though it has only led to modest short to medium-term weakness in stocks. More than 40% of the indicators were showing an optimistic extreme by Monday. When there have been so many overly optimistic indicators since 2000, the S&P 500 has struggled to maintain gains over the next 30 days. Even during the past 7 years, stocks have pulled back over the next 3 to 6 weeks almost every time. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:54 a.m. Mountain Time, and I am recording this in preparation for the market day of June the 8th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Members, be sure that you review the monthly business cycle review that I posted yesterday. That should be available also in your emails from yesterday. A very, very comprehensive review of the current conditions in the business cycle and what that might mean in terms of future potential of recessionary phases. Okay, let's go ahead and get into the morning report. And at the time of this cut, all 4 U.S. indices are up just above scratch with nothing of note. Crude oil's up about 1.29%, euro's up just above scratch, bonds are down just below scratch, and gold is up about 0.75%. China down about 1/3%, Hong Kong down just below scratch, Japan up nearly 1%. Germany down about 0.5%, and the United Kingdom is down just below scratch. In terms of U.S. macroeconomic reports for today of note, you have JOLTS job openings, the weekly crude oil inventories, and also the regular 10-year bond auction. In terms of looking forward to tomorrow, you have the weekly unemployment claims, And a 30-year bond auction. That would seem to be about it. Current volatility conditions have been increasing of late, 5-day versus 10-day as our definition. Note also the short-term VIX, a little bit up off its low. We were in the 10 handle. We're now at 11.56. Skew in the cautionary area just above the 125 threshold to trigger our attention, though not excessively high at this time. In terms of IV percentile, the S&P is at an 11, the Russell a 13, the NASDAQ at an 8, and the Dow at a 5, so all four exceptionally low areas. No standard deviation moves were put in yesterday on a close-to-close basis on any of the U.S. indices. And the average over the last 2 weeks is relatively low. We normally see about 4 standard deviation moves in a 2-week period. Right now we're looking at about 2. In terms of the charts, let's go there. Let's go ahead and start with the S&P 500. Be aware that all 4 of the indices futures contracts should be rolling over to September within the next few days. Watch the volume, and things can often get pretty choppy on the trading when that volume gets split between the 2 contracts. So that can lead to some really poor short-term trading if you are one of those. And anyhow, bottom line though, we have been probing into this area of resistance that we have talked about for so long, and yesterday's close, had the potential for a shooting star, as one of the morning reading authors mentioned, but right now that does not seem to be confirming. We are up, and you see we continue to probe higher into the area of resistance. So we'll continue to watch this. If the day ends up significantly weaker, that could be a potential shooting star right there. But that does not seem to be the case at this point. Let's see here. Of anything else to mention here? The main thing is just to see where we get with this area of resistance. If that fails, then we'll start to examine possible points of support. There are many. So I took a number of new positions yesterday myself, and you always feel a little odd when you're taking these positions into the areas of resistance like this, and yet we continue to build on this. So ultimately, as we look at our daily report, and we'll get there in just a moment, everything is pretty solidly bullish. So any retracements back into this former consolidation area, I would expect to be just that, just retracements into consolidation. I don't see at this point any significant breakdowns being warned of. Now, new information could come into the market and change that in a hurry, but it's not obvious that there's untoward risk to the markets at this time. The Dow also has been pushing up, and while it could have had a potential shooting star, doesn't seem to be confirming there either. It's, of course, been in a relatively weaker position and still needs to obtain the previous swing highs, unlike its brother, the S&P 500. In terms of Russell futures, you see it's been making some very impressive new highs, though in the big picture has a very long way to go to get back to its all-time highs. The S&P is less than 0.9% away from its all-time highs, and indeed if you use the SPY, it's my understanding that we have come in and tickled those all-time highs. Let's see, this right here had a closing high at 212.78, and yesterday we had a close of 211.35. So actually yesterday would have been this one here. Its close would have been 211.68. So we're just right on the verge of taking out this all-time high from a year ago on the Spiders ETF. So of course this gets configured with dividends, and the price, action's a little different than the SPX or even the ES futures contract, as a result of differences in hours and opening and closing, and then differences in the effect of dividends. So that's why you see some subtle differences. For charting purposes, we generally prefer to use the futures chart, or secondary, if we want to see with all market participants, the use of the SPX index. Okay, let's go ahead and go to bonds. Bonds had that very impressive breakout last week, and certainly seems to be holding those breakout gains, though it's interesting that we've come right up against this former swing high and it failed right there. So like to see if we can get through these swing highs here, both very, very close proximity. So we would call this an area of resistance, and we need to break through that area to see bonds do the next leg, most likely. In terms of crude oil continues to make higher highs, and you look at this. Even if this were to roll over right now, we've got a higher high and a higher low. So we continue with the progression. And I believe also one of the morning authors also mentioned, oil coming in with its highest close since a year ago. So we really are starting to talk about being able to come into contention of the 55 to 60 area. And I don't see anything in the way of that at this time. Now, gold, been a very complex consolidation, though you got to remember this has been, apparently a bottoming that has broke, and that doesn't mean that you just go off to the races. In the big picture, longer term picture, this could very easily go and achieve well past 1,300 and make runs even towards 1,400 if you're patient enough to see that trade develop. But it's likely to chop around for periods in between. So to get a hold of these kinds of moves, you have to put up with these kinds of moves. So very, very choppy pattern here, but there is still a bullish potential there if you're willing to play the larger moves on gold. And let's see if there's anything else. So let's take a look at volatility. I continue to watch for the VIX to get below a 13, and it did apparently early yesterday morning. I missed this in my what should I call them? The alerts didn't fire off, so I'm not sure why this candle is showing an open of 12.77 when my alerts were supposed to trigger at a 13. But nevertheless, I'm looking for opportunities to set up some additional volatility hedges, and ideally would like to get those put on with the VIX below 13. And we certainly are playing with the zone, so if you're also of a mind to be putting on those hedges when the VIX is really, really low, that should absolutely be on your watch list. Let's go ahead and go to the daily report, and some subtle changes here, but still this is overall the consensus of this upper section where we have our market timing signals are all very, very positive. Intermediate term phase opinion, still phase 2, a bullish trend reversal setup. In terms of the three market timing signals, IBD, our first one, in confirmed uptrend. The second one, GMI index, a perfect 6 out of 6 with a buy signal in place since 525. Note the more sensitive GMI2 has improved a notch to a 7 out of 8. In terms of stock charts, decision point scoreboard, the third mechanical signal, universally bullish on all signals in the short and intermediate term, and only the thicket coming in from the long term giving us mixed signals. So that's about as strong a setup as you're going to get from the market timing signals. And really, of course, we'd probably need all-time highs to be able to trigger that, but all-time highs are not that far away. I'm seeing these long term go all green and giving us the perfect stack. and that's where trend moves often reside. So we're very anxious to see if that can develop and we can get into a new trend mode and finally break out of this months long sideways range action. Has not happened yet. There's no high probability it will happen, but the potential certainly is setting up, and that could make for some very good trading if that were to happen. Position sizing opinion on both models is at 100%. Intermediate term market posture is very strong, with our benchmark S&P up over 90. NASDAQ and Russell also well up over 90. The Dow continues to incrementally improve, but this one has been in relatively lesser strength in terms of its bullishness. But still, at a 67, this is considered a strong bull, so in itself is not, in any kind of bearish kind of stance. In terms of hedge warning status, we still remain at level 1. I've been toying with going to 0+. And there's just a couple things that are just kind of concerning me that prevent me from doing that. And one of those is this distribution day count, still high. And then even more importantly at this point, I've come to recognize that this key intermarket risk aversion indicator is often some of the most sensitive. And when they fly and turn to risk off, like they have here with 4 of the 5 signals in the risk off position, and the 5th one getting very close to going to risk off, it's very hard to lower and call normal the hedge warning status. So kind of keep that in mind. From a strategy opinion standpoint, no changes from yesterday. Generally acceptable to initiate positions on all 3 strategies. Be somewhat defensive, especially since we are up against this zone of resistance, and you hate buying the top, and yet at the same time, if you are a follower of IBD principles and William O'Neill, it is the growth strategy that is often accompanied by just this kind of action where you have high breakouts and clean air above you that proves to be the most productive over the long-term kind of setup. So these are the kinds of conditions to set up covered call strategies. I set up several yesterday, and certainly I used a mix of lower beta and higher beta positions in my portfolio. The stuff I added was certainly had some new high beta positions, but I also have plenty of the lower beta positions in my portfolio of covered calls. Also, my ratios, very much this blend of strikes of being either in the money or at the money. Many of them were right at the money, plus or minus a little bit, and then out of the money strikes allowing for growth as well as option premium return to drive that performance. And in terms of put selling, also did some of this yesterday. And so, a mixture of positions. Probably need to do something more with option income strategies, but it's that kind of marketplace right now where it is begging to increase your exposure while at the same time mindful that there are still these warnings in place. Now, not a lot of them. The volatility ratio warning did fire yesterday. We still have that VIX daily squeeze, which can go on for a pronounced amount of time, but when it does fire, it can often be pretty ugly. So we're continued to have our radar screen sensitive to that potential. And then of course this distribution day count continues to hover in relatively high areas, and certainly it's still in a warning status. Skew, as I mentioned earlier, is just above warning status, about a 9% probability of a 2 standard deviation move in the next 30 days. But then the bulls, certainly, we look at some of these, especially trend-based, phase 2, severely strong bull, New York Stock Exchange, new high, new low, 757 put in on the new highs yesterday. So there's a lot to be said that the bulls are, clearly dominating, especially in the short to intermediate term, and you have to respect that as well. Also from sentiment, relatively high sentiment on stocks in the short term, also on bonds, pretty high number there. 10 is the max. SMH the ETF that's also showing up as pretty high sentiment scores at this time. So watch for reversal patterns across all those markets. Fear and Greed Index, one of the morning authors mentioned this, and indeed, look at this, an 81. We've seen some tickling in that 75. In fact, a week ago we were 75, but we are getting well up into this upper quartile. It's very rare that you see readings up, in the, 90 and so forth. So this 81 is a very, very extreme kind of level. And got to keep in mind, that much like what we talk about here with these other sentiment indicators, is a sign for us to have sensitivity to potential reversal patterns. One of the morning authors mentioned the potential for a shooting star. Well, right now that doesn't seem to be following through, which would mean the bulls are carrying the day. But that's what we should be doing. We should be watching for potential reversal patterns. And like the morning author mentioned, that you might tighten up your stops when you have potential reversing patterns when you are doing short-term trading. So you wouldn't tighten up your stops to your core portfolio positions just because of a potential shooting star. But those short-term, very short-term swing kind of trades, that might be where you would tighten up your stops. In terms of sector specific, look at this, just about a universal sea of green, short, intermediate, and long. Only one signal from retail in the long term, now at a neutral. In terms of percent change yesterday, energy, telecom, industrials leading the way, energy having a very, very big day. And indeed, you look at this over the 5-day, 1 month, and 3 month, energy has come a very long way and has really piled up some impressive performance. That should be enough for today. We're just over 20 minutes, so let me go ahead and roll through the sequence here. If you see something of interest, just hit the pause button and go to your hyperlink for the additional details. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And as always, note the hyperlink here at the bottom for the full set of disclosures. In the meantime, we'll see you back here for tomorrow's session of the market preview by Falcon Global. And good trading to all.